When 2020 started, GameStop seemed like a company destined to become a relic of the past. The stores have been selling video games, physical discs, consoles, controls, and curios since 2002. But for years, customers have been increasingly downloading video games directly to their computers and devices. The video games publishers started to distribute them without the need for physical store sales. And like any other chain of physical stores, people now shop online. GameStop business was dying slowly. Then the pandemic began. GameStop was closed or scaled back its operations, and due to lack of customers in malls, its sales were falling and hundreds of millions in losses were accumulating. To institutional investors, the conclusion was simple. GameStop is the next blockbuster movie rental chain. They started to take positions betting that the stock price would fall, short selling. It begins with a loan of shares by an institution and their immediate sale. If the price of the shares is lower than they paid, the institutions purchase it back a lower price and deliver them to the lender, pocketing the difference. There's a problem with the bet that the stock price will decrease, called risk. If a stock falls from $10 to $0, you have a maximum gain of $10. But if it rises from $10 to $100, you will lose $90, and if it rises to $500, you will lose even more. Because theoretically there is no maximum price in rise, and therefore no limit to what can be lost. It was known that in 2020, GameStop stock became one of the most sold short on American markets, with figures reaching 100% of the public floating shares of the company for several months in that year. That does not mean counterfeit stock was generated, because an identical share could be bought and resold several times, and it could even be borrowed and lent from one entity to another in the same day. This created a structure that was ready to burst under pressure. If a lot of people are betting that the price will go down, but a lot of people start buying and the price goes up, all the short sellers will be forced to buy the shares at much higher prices in order to limit their losses, which will make the price of the shares go up even more and force more and more short sellers to cover their position. Wall Street saw the decline of a retailer. A small group of internet investors saw a nuclear weapon ready to detonate, only they were missing something to pull the trigger. Long before GameStop became an international headline, a particular investor had been chronicling the video game retailer online. His name was Keith Gill. He went by the online alias Roaring Kitty and the Reddit username Deep Fucking Value. Gill's case was not that GameStop had suddenly transformed into a paragon of the retail industry. His argument was that Wall Street had gone overboard, that the stock was cheap, and that GameStop still possessed a strong brand, a loyal customer base, cash, and the potential to benefit from a new generation of consoles. Most of all, the number of short sellers investors who stood to make a killing if the stock decline appeared out of proportion. He presented research papers, spreadsheets, YouTube videos, and snapshots of his own investments to prove the case. For months, nobody much took notice. Some outright mocked the idea. Then the famous online retailer Chewy.com CEO, Ryan Cohen, entered the picture. Cohen had helped make Chewy, a retailer of pet products, into a force to be reckoned with even in the shadow of giant retailers. In 2020, he had begun purchasing GameStop stock and subsequently pushed the retailer to modernize. His participation in GameStop elevated the optimistic scenario. GameStop was not merely a beleaguered shopping mall establishment. It was now a potential comeback story helmed by a capable tech visionary, one with a significant group of stock short sellers ready to pay for the gamble. The fervor spilled over onto the Reddit community called Wall Street Bets, a group not much of decorum, but ripe for outrage and the thrill of high-stakes risk. It was a forum where users posted the fruits of wildly successful gambits and the crushing losses from those that went bust. Complicated options trading and memes were thrown around together, and profanity flowed freely. Amid the chaos, however, thousands of users were targeting the same vulnerable point. If a great many investors began buying GameStop stock and held on for dear life, they could drain the available supply. A portion bought standard shares. Others purchased what are known as call options, a financial instrument that gains value as stock prices rise, a strategy that, when enacted, often force other parties to buy the underlying asset to cover their own risk, in turn pushing the price further up. Reddit, unlike the executive suites of a hedge fund, has no command structure. There is not a chief executive to orchestrate 4,000 people from thousands of computers to buy a stock simultaneously. The story had evolved closer to the shared realization by a public crowd that there was a trade available for the taking, and each new price jump fueled a growing number of stock purchases. Each screenshot of profits added to the appeal of Wall Street bets, creating a feedback loop between meme culture and the inflow of cash. GameStop was no longer solely a trade on its merits. It had become something else, a culture war waged from a desktop. Many of the traders seemed to carry grudges toward the institutions they'd seen rescued in 2008, while their own households struggled, and now they were witnessing hedge funds squirm while on their phones. Anyone could take a jab. This was not just a trade at GameStop. It was a crusade dressed in stock prices. In January 2021, GameStop began moving. At first, the upward trend could be rationalized by rumors of Ryan Cohen and of how GameStop might be transforming into something better. Then the momentum picked up. In the beginning of the month, the share price was below $20. On January 13th, in a single day, it jumped by more than 50%. Additional buyers were drawn into the stock, as was attention from financial journalists, social media, and options traders. The short sellers were now under pressure. As the stock of a heavily shorted company climbs, brokers demand additional collateral from those who bet against it. Some short sellers withdraw on their own accord to avoid accumulating bigger losses, while others are forced to close out their trades. To close out a short trade, one must buy the stock. A bizarre feedback loop in the market develops when this happens. The same individuals that anticipate the collapse of a company suddenly become those pushing the share price up as they need to buy it. GameStop climbed past $40, and then past $70, then past $100. On January 27th, its closing price was over $340. The following morning, its price briefly went close to $500. Television news channels interrupted regular programming to report on it. Reddit servers crashed due to the high traffic. Politicians, celebrities, business magnates, and stock traders discussed the skirmish on the news. Some investment firms suffered heavy losses. Melvin Capital, an investment fund well known for shorting GameStop, received billions of dollars in aid when their trades came under severe duress. However, the common narrative misses a crucial aspect of the situation. Later, the Securities and Exchange Commission reviewed trade information and found that the buying from short sellers contributed to certain upward spikes in the share price. Yet, despite this, the price of the stock continued to rise even after the most intense short covering abetted. The report also showed persistent positive investor sentiment was the other major driver of the increased price. This was not simply an automated machine annihilating short sellers. It was a buoying frenzy. It was people buying shares of GameStop based on the assumption that more people would buy shares of GameStop, and the upward surge in the share price served as evidence that this belief was self-validating, leading still more individuals to pile in. Short sellers, private traders, professional investors, options dealers, algorithms, and momentum investors were caught up in the same swirling tempest. No individual or group controlled it. GameStop's price was no longer determined solely by its stores, sales, or potential profits. It had become the price of believing. Then, on the morning of what seemed to be the showdown, millions of investors loaded their trading apps, ready to jump into action, and to their shock, discovered something they did not expect. They could no longer freely buy shares of GameStop, though they were still able to sell them. Robinhood and a dozen other brokers imposed purchase limitations on the GameStop saga and other speculative stocks on January 28th. Customers were still permitted to close their positions, though further purchases of these assets were largely blocked. The move generated an immediate backlash. To retail investors, the implications seemed clear enough. They concluded that the big-time financiers had lost the fight to ordinary people and changed the rules. Robinhood had crafted its image as a democratizing force for ordinary individuals. The app had deliberately invoked the name of the heroic outlaw, who stole from the rich and gave to the poor. In the most pivotal moment of the rebellion, the platform named Robinhood had removed the buy button. GameStop stock plummeted through the session before partially rebounding. Accusations proliferated on social media. Some claimed the hedge funds had colluded to pressure the brokers into halt the short squeeze. Others said Citadel Securities, a primary market maker, which processed most of Robinhood's client orders, and had business interests that were aligned with firms propping up Melvin Capital had pressured the platform to curb the onslaught. In reality, the forces behind the restriction were far more complex and opaque. When a user taps a button to buy a stock, the transaction doesn't instantly finalize. Back then, settlement of the stock trade generally took 2 business days. In the interim, clearinghouses required brokers to put up collateral against the market to ensure they fulfilled their obligations if either party failed to deliver. As the price and trading volume of GameStop soared, so did Robinhood's collateral requirements. By early morning on January 28th, Robinhood's collateral obligation with the clearinghouse reached around $3.7 billion, dwarfing its existing deposits. Robinhood entered discussions with the clearinghouse. A portion of the requirement was waived, and the rest of it was decreased after the brokerage agreed to limit trading in the most volatile securities. The buy button was disabled not because Wall Street was losing and wanted to cheat the public, but because the brokerage firm could no longer safely support the velocity of trading occurring in the securities it listed. That explanation didn't do anything to address the injustice. While Robinhood had enthusiastically fostered Swift, easy trading, and marketed itself to beginners with a stripped-down app and no trading commissions, when a group of its clients traded a single stock on an unprecedented scale, its risk system struggled under the stress. The plumbing was adequate until the plumbing became overwhelmed by the crowd. Congress eventually investigated the GameStop incident. The hearings brought before them Robinhood's executives, officials from Citadel Securities, Melvin Capital, Reddit, and a famous GameStop investor known as Keith Gill. The testimony revealed an uncomfortable truth. The trading apps offer the veneer of a simple, zero-fee marketplace, but in reality a complex, inscrutable chain of market makers, clearing houses, collateral obligations, settlement delays, and business entanglements supported its function. It wasn't just one clandestine phone call that had stopped the market, but the financial infrastructure itself that nearly nobody had any knowledge of. GameStop price tanked brutally after peaking in January. Some of early players exited with life-changing profits. Keith Gill became worth tens of millions publicly. Traders who unloaded near the top generated a lifetime of returns in days. Others showed up late. They had bought shares only after television news, social media, and newspapers reported on GameStop's surging share price. Some of these investors figured there would be no ceiling. Others viewed it as loyalty not to quit. When the price cratered, these investors were left with enormous sums to absorb. Hedge fund traders were not wiped out as a class. Wall Street did not cease to exist. Professional trading firms also rode the wave, profited from volatility, or adapted their positions much faster than average investors. Nevertheless, something was different. A cohort of anonymous online traders had sniffed out a genuine fault in a widely held bet against a stock by a long-standing Wall Street institution. They turned an ignored video game store into the most talked-about company on the planet, caused $40 billion to vanish, and drew the attention of Congress to the plumbing beneath the interface of every trading app. The episode also showed what can happen when stories dominate markets. The GameStop rally was based on actual reasons: extreme bearishness, huge short interest, the launch of new video console generation, Ryan Cohen's presence on the board. But the stock's run-up added narrative layers. This then turned into a story about individual investors against institutions. Later, it mutated into a narrative about whether refusing to sell was an act of defiance, whether declines represented manipulation, or whether the rise indicated that final explosion was around the corner. This narrative made the story very hard to discredit. The GameStop saga wasn't a simple win by Reddit or a crushing defeat of individual investors. It was a demonstration of market mechanics, social media, indignation, fun, and capital all fused into one inseparable thing. Reddit found the crowd had leverage. Wall Street found a retail investor could not be ignored. Robinhood learned that it did not reduce complex financial risk by simplifying the interface. And tens of millions of ordinary people learned that joining a rebellion is not a promise to prosper from it. GameStop did not break the fundamental laws of Wall Street permanently. It revealed the rules. The market was not being propelled solely by income statements and the opinions of smart professionals. It was also propelled by margin calls, the available pool of cash, leverage, liquidity, the pursuit of returns, entertainment, human emotion, and confidence. For one exceptional week, the future of an ailing video game retailer was the locus for it all. The professionals had their models, Reddit had its numbers, and Wall Street had its nerves shaken. This is a Noir ledger. Every fortune leaves a paper trail. Every revolution earns its margin call.